Alright, hope everyone's doing well. So, first and foremost, I'll start with always in, and then I will discuss a, one or two trades I took, maybe one good trade and one bad trade. But first, for always in, you know, coming into the day, I think we were arguably always in long because of the micro channel. Here's the session break. I traded the spider, not the Emini today, but they look the same. So, probably bar 2, always in long, but, personally I would not put my stop below bar 1. I'd probably put it down here because there's too much risk. This rally's weak, too much risk we fall a tick or two below and turn up, kind of like what we did here. That happened in the spider. We did not? Huh, weird. I thought it did. Maybe it didn't. Uh, Anyways, always in long, first person down should fail. I'm thinking trading range, we broke above the all-time high, had a fairly deep sell-off. This rally's weak, so if we break above again, we'll probably break above this high, which we did, but, I'm thinking trading range, so I'd get out. If I didn't get out, maybe get out below here, but here's kind of the problem. So, here, let me point this out. This is, maybe I'll do it this way. Yeah, I like that more. Okay, so from this high to this low, this pullback is about 47.50 to 43.50. So it's exactly 4 points from high to low. Okay, so we broke out to the upside. Well, traders are going to expect the pullback to be not much bigger than 4 points. So look where you're selling. If we know that there's probably going to be buyers 4 points below because there were buyers 4 points below this high, if I sell here, that doesn't give me a lot of room. So therefore, I think it's a limit order market. Traders are buying below bars. These stops, all these stops through here for the shorts, are forcing you to sell too low. So, always in. If you get out, I think you got to get long again. And really no reason to get out if you ask, if you want, in my personal opinion. But then again, I really don't like to trade always in on days like this. It's not, to me, I would rather look at other markets. Look at Apple, or this is a 15-minute chart of AT&T. But anyways, here's Apple. I don't know why that thing keeps popping up, but here's Apple. Just, buy this close, stop down here, and, take your profit. Or, buy this low or somewhere down here, betting that price retest the close. Buy this low, scale in. Buy above this bar, stop down here, scalp out. I prefer doing that when the market looks weak. And, you don't make as much and you have to trade smaller, but it's, to me, it's far more consistent, which is I'll happily choose consistency every time. So, what did I do today? A few things I did. In the spider, I think I only did 2 things. I think I bought this close, scalped out, and I think I bought and scalped out just up here for 10 or 20 cents, and then I think I bought here I scalped part off at 10 cents, hoping we'd break above the high, but ended up making a mistake and getting out below this bar or somewhere over here. I should have just held, betting the first reversal down will fail, and then scalping again at 10 cents, but I didn't do that. In terms of the trade, here's one that I could have done better on. I really wasn't the best, really wasn't a great trade. I bought this close or somewhere down here, betting price would test this high. And I had a stop down here, and I scaled in, 30, 20 cents lower, somewhere over here. And I had my stop down here. Thought about scaling in here, but didn't. Thought about getting out of break even, and when we had this bar and this tested up, I really thought about it, and I should have gotten out of break even. Just because, really what I was doing was kind of similar to this. You buy these closes and you scale in, betting that price is going to at least retest the high close. However, very weak rally. Look at the first bar of the day. It's above yesterday's high, so it's really just not, it's really too high in the trading range. Kept my stop down here. I got lucky, to be honest. I scaled in basically 3 parts. 1 part, 2 part, and somewhere over here. Ended up getting out of break even. So, it took a lot of effort. But, at the end of the day, sometimes that happens, and that's the nice thing about trading small is you can scale in and manage positions, but you have to be careful with that because, it really wasn't a strong trade in the first place, and, if you take a big loss, that can eat away a lot of hard-earned profit on other trades. Let me think. Walmart. Oh yeah, I think I sold one of these. I sold the second close. Did I? Yeah, I sold the second close and I scalped out. I don't remember. I really think I just sold and just set a limit order to take profits 20 cents lower or something like that. I know I did more. I'm just trying to remember. And I bought here, and my reasoning was this. So you remember back to what I just said about this pullback being only 4 points. So when this pulls back close to 4 points, traders are going to start buying. It's the same concept. One thing that works really well in a strong trend is, so you get a signal, you get a stop entry short. And this is why always in is really, really helpful if you understand it well. Or let me restate that. This is why I feel it's important to get a very solid understanding of always in, or gain an understanding of it, because if you understand what the swing traders are doing, it's easier to scalp. So what I mean by that is, so bar 1 always in long, no reason for bulls to get out, strong breakout, and this signal bar. You can make the argument, parabolic wedge. It really doesn't matter. When I say parabolic, all I'm meaning is the trend lines are getting steeper and steeper. So, the move's getting stronger as it's going up. Therefore, it's unsustainable. And at some point, it's kind of like this. Take this risk reward. The bulls who are buying up in here have their stop down here. It's far away, but that's why you trade small. and their target's up here. Well, that may not be achievable. So a lot of bulls will, take profits, and they might exit below here. But if they do exit, guess what? They've got to get long again above a bull bar, probably above here, stop down here, and you can see they would basically break even. Second, this bar is a reasonable buy the close bar, and I'm going to tie into what I did in just a minute. Why? Reasonable buy the close bar. So if I buy this close, put a stop down here, I can avoid a loss most likely. It happens almost every time. You buy this close, stop all the way down here. Realistically, probably somewhere down here. You scale in lower, scalp out a break even. Buy this close, scale in lower, get out of break even. You can see that's what happens in trading ranges. 112.38, price went to 112.43, so clearly enough. So that was my thought. My thought was, okay, we're about 48, we're almost 40 cents, give or take, we're about 40 cents away from the high close. If I buy right here, this move isn't strong. If I buy right here and put a stop down here, at a minimum, I could probably get out of this close for a scalp. So part of that is because I've learned through many, many, many mistakes of, strong rally. I'd be trading always in, I'd get a strong rally, and I'd say, ooh, I'm going to get out, but I'm going to be smarter, and I'm going to get out of this bar. I'm going to get out of my longs and go short. And I would not get back to long, and then I'd be short. And I'd be holding short, holding short, holding short. And eventually, I don't even know what happened over here. I guess it sold off. But in any case, I'd be holding short, and more times than not get stopped out. Now in this case, I think this was actually the high today. Yeah, it has been. But from what I'm saying is, it's very helpful to understand the always in direction. So I don't want to go too far in that. And by the way, strong, probably enough bars down for at least a small second leg. And you can see disappointed. This bear bar is bulls buying back the shorts at the buying back their longs at the high close. We're selling out of longs at the high close. So I bought, scalped out. And next thing I did, weak sell off. I bought above here, stopped down here, and just exited somewhere up there. And in part, it's the same reasoning It's always, and this all ties into always in it. Right now, it's trading range. However, always in bulls are thinking to themselves, well, as long as we stay above this low, it's always in long, so buy for any reason. The reality is we've gone sideways for over 20 bars. It's probably a trading range. You have a logical stop and a logical stop. So you have two forces. You have bulls buying when it comes close somewhere down here, bears selling when it gets up here, which forces something in the middle. And you can see we are right in the middle in between these two lines. Eventually we'll get to one or the other, but right now we're neutral. And my thought was, very often you can kind of make the argument here. It's not as great, but very often when you get, let me just find one real quick. Just to hope I can show kind of a decent example of what I'm talking about here. It really doesn't matter. Tell you what, here. I mean, this works. So gap up and a channel. Arguably, it's always in long unless we get down below here. But the reality is, when you get these 4 bear bars down, it's strong enough that you're going to probably get a measure move. So it's always in short, clearly. In Apple, strong breakout, there's no clear breakout bar. In other words, every time we go low, bulls buy, possible give up bar. Yeah, but it's 50% pullback and it got bad follow through. So, I see this, I see the bad follow through. My next thought is, okay, we'll probably get back to this high. You can probably sell it, you can probably buy it if you manage the trade. And by managing, I mean you buy and you buy more lower, scalp out. Same thing down here. If you could also just buy this close, buy above here, scalp out somewhere up here. So until we get a clear give up bar, like this, like something like that, it's still always in long. Same thing for Facebook. Until there's a clear give up bar with follow through, it's always in long. The bears, they had a chance with this bar, but if you look at a 1 minute chart, this bar was 10:30 to 10:35. I don't know why that keeps happening. I apologize. Let's go find 10:30 to 10:35. Here it is. This was the first bar of that bear breakout. And look at the follow through. Big bull bar closing on its high. Another bear bar. Big tail. Another bear bar. Big tail. So what does that mean? That means that you could see this bar break to the downside, have a deep pullback, go back down again, deep pullback, go back down again. So bulls are making money buying every bear close on the 1 minute chart, which means that it's probably a trading range. The bears needed something like this, a give up bar and more down. So that's overall most of what I did today. Really just, I don't, kind of always ends great, and personally, my favorite thing is breakouts, buying and trying to go for a measured move, but really, I've just learned through time, it's not fun to sell this close. Now, it can be rewarding, but selling, this is an okay example because, you're always in short sell, bears get out, maybe bulls go long, but bears got to get short again, bulls get out, bears get short, and so that's an okay always in day, but, there's plenty where it's kind of, sorry, it's kind of like this, or, this. So anyways, comment below if you have any questions, and thanks.